The problem with getting a mortgage these days is that the underwriting guidelines want every single borrower to fit perfectly within their criteria. And if they don't, they can't get a mortgage. But what we've learned is that there are many borrowers who have unique purchasing situations, such as individuals who might not have 2-year employment history. How about those individuals who are business owners who have wizard accountants? And what about those individuals who have a ton of assets but not a lot of income? What do we do for those borrowers? Well, if you hang with me till the end of this video, I'm gonna show you all of the different loan products that are available to fit these unique purchase situations. Now, these unique mortgage products are referred to as non-qualified mortgages, or non-QM. And within the non-QM family, there's virtually a product to meet every unique purchasing situation. But before we talk about what those products are, we have to talk about what makes a non-QM loan different than what we refer to as a qualified mortgage. And a qualified mortgage is simply the mortgage that you would typically get. The first difference is that non-QM loans do not have to conform or meet the consumer protection requirements set in place by the CFPB. And these requirements are in place to protect both the lender and the borrower from default due to high risk of the loan. The second difference is that non-QM loans are not insured, guaranteed, or backed by Fannie Mae or Freddie Mac, the Federal Housing Administration, or the Department of Veteran Affairs. This is what you would typically see if you got a conventional FHA or VA loan. Lastly, non-QM loans follow their own set of underwriting guidelines and requirements. This is what allows them to be offered to these unique purchasing situations where you would run into a roadblock if you tried to go the qualified mortgage route. Now that the boring stuff's out of the way, let's have some fun and talk about all of the different non-QM products and who those products would be ideal for. The first product is designed for individuals with 1099 income. So these would be our independent contractors and our freelancers. In our industry, I think of the realtors. Now, this product is amazing because you only need 1 year of 1099 income and you're allowed to use 90% of your 1099. All you have to do is show 4 months of bank statements to prove the likelihood of continuance of that income. So let's say your 1099 shows $150,000 for the year. We can use 90% of this, which is $135,000, and that's the gross annual income that we can qualify you based on. This is a huge help because what happens if we go the qualified mortgage route, you're taking write-offs, you're taking other deductions, so the usable income on the file is significantly lower, which means you qualify for less or you don't qualify at all. The next product is the bank statement loan. And this can be used with either business bank statements or personal bank statements with as little as 12 months history. So this is ideal for our business owners, especially the ones with the really crafty accountants. Now let's start on the business side. You've got 2 options on the business bank statement side. The first is that you can automatically use 50% of the qualified deposits. This is to account for what we refer to as an expense factor. The other option is to get this number lowered by getting a letter from your CPA supporting a lower expense factor. You can get this lowered all the way down to 10% of the qualified deposits. So let's say that you have $20,000 worth of legitimate bank deposits coming into this account each month. At a 50% expense factor, we can use $10,000 gross monthly income on the file. And if we got a CPA letter supporting as high as a 10% expense factor, you could use $18,000 gross monthly income as qualification on the file. Switching to the personal bank statement side, this is even more straightforward because you can use 100% of the qualified deposits in the personal account with evidence of a separate business account supporting business operations and activity. The next product is the asset depletion loan. And this allows an individual to qualify based upon the assets that they have. So this is perfect for somebody who might not have significant income at this point of their life, but has done a fantastic job accumulating wealth over the years. So what qualifies as a usable asset? You can use 100% of the value of your checking, savings, or money market account. You can use 80% of the value of your stocks, bonds, and mutual funds, and 80% of the value of your retirement assets if you're 59 and a half or older. Now, before you just take those respective percentages, you have to also account for your down payment, your closing costs, and the required reserves. So once you've backed those out, you then divide that number by 84 to give you the usable income for qualification. Lucky for you, I'm gonna show you an example. So let's say you've got $1 million in savings and another $5 million combined between your stocks and your retirement assets. We know that we can use all $1 million of your savings and 80% of the stocks and retirement assets, which is $4 million. So we add those two numbers together and we have $5 million worth of eligible assets to deplete. But remember, we also have to account for the down payment, the closing cost, as well as the required reserves. So our down payment would be $500,000, our closing cost another $20,000, and the required reserves another $30,000, which leaves us with a total eligible assets to divide by 84 of $4,450,000. And when we divide that out, that gives us a usable gross monthly income of $52,976 for the file. The next product, and my personal favorite, is the DSCR loan. And this stands for Debt Service Coverage Ratio. Now, this product is designed specifically for investors because you qualify for the loan based off of the cash flow of the investment property. This means that your income is irrelevant and you don't even need employment history on the file. This is truly as close to a no-doc loan as you're gonna find. So how exactly does this loan work? Well, there's two parts to the DSCR equation. The first is the gross rent that the investment property will generate. The second is the total payment for that investment property, which we refer to as the PITIA, which is the principal and interest, taxes, insurance, and association dues. So for any DSCR loan, all you do is take the gross rent and divide it by the total payment. If that number is greater than 1, it means the investment property has positive cash flow. If it's less than 1, it means the property has negative cash flow. Essentially, all you're trying to do is see if there's more rent than there is payment. So let's look at an example. Let's say that you have gross rent of $2,500 a month and total payment of $2,000. You have a DSCR of 1.25 and positive cash flow. Now, if you're already a real estate investor and you've gotten an investment loan via the qualified mortgage route or the traditional route, you already know how much of a headache it is because you have to submit your tax returns and verify all of the investment properties that you own. With a DSCR loan, you don't have to do any of that. They do not care about your other investment properties. And what makes it even better is that you can qualify based off of a short-term rental income. So things like VRBO and Airbnb. And to top it all off, normally you're restricted to a 1 to 4 unit on a DSCR loan, but with these DSCR loans, you can go all the way up to 8 unit investment properties. The next two products are designed specifically for condos. And the first is the Condotel Loan. And if you're not familiar with what a Condotel is, you can actually buy an individually owned condo that is run and managed as a hotel or motel. Now, typically the requirements here are that the unit has to be 500 square feet or more, has to have a fully functioning kitchen and a separate bedroom with a DSCR over 1. The second condo product is for non-warrantable condos. So if you haven't yet watched my previous YouTube video, 6 things you need to know before getting a mortgage on a condo, I highly suggest you start there. But to quickly recap, every homeowners association will have to meet certain requirements. And if they don't meet those requirements, sometimes you can't get a qualified mortgage on that condo. So this product is designed to come in where that may happen. So what happens, for example, is you may have a condo building that has too much commercial space relative to residential. That might be perfect application for this product. You might also have a condo association with too much of an investor concentration. Again, this non-warrantable product might be the perfect solution. The last product is called the ITIN Loan. And this stands for Individual Taxpayer Identification Number. And this product is designed for individuals living and working in the US without legal residency. So you don't need a visa or an employment authorization document for this loan, but you need either an ITIN or a social security number. Now, you still have to have stable income and employment and be working to get this loan, but it is a great product for individuals without legal residency. So I've shown you all of the most popular non-QM products, and hopefully the pessimist in somebody out there watching this is saying, what's the catch? This sounds too good to be true. Because as you know, and as I always tell you, nothing in the mortgage world comes without a trade-off for something else. So what are those trade-offs that you give up for that extra flexibility? Well, the first is that these non-QM loans come with increased costs. So expect to see two things. The first is that your interest rate is going to be higher than a qualified mortgage. The second is that the cost of getting that mortgage is also going to be more expensive because almost every single non-QM loan will have points that you need to pay as the borrower in exchange for that loan. The other two big drawbacks of these types of loans are that the minimum down payment requirements are higher than a qualified mortgage, and you also lose some control of the underwriting process. Now, losing control of the underwriting process truly isn't that big of a deal, but it is something to know upfront when you're accounting for closing dates and quick turn times. By this point, my hope is that you can see the application of these unique lending products. And while the cost may be a deterrent for some, for others, this can literally be the difference between securing a property and losing it entirely. So if you're ready to get started with a non-QM loan, click the link in my description and let's connect to chat further. As always, thank you for being here. Please don't forget to like, subscribe, and comment, and we'll see you back here on the next one.